A company with no ships, no cargo, and no real business became worth more than the British government itself. London 1711. The British government owed money it couldn't pay. The War of Spanish Succession had drained the treasury. Creditors were restless. A merchant named John Blunt proposed a solution: create a new company, call it the South Sea Company, give it a monopoly on trade with South America and the Pacific, let it assume the government's debt. In exchange, the company gets shares that pay dividends from future profits. It sounded clean. It wasn't. The South Sea Company began trading in 1711. Its charter was real, its monopoly was real, but something else wasn't. Spain, which actually controlled South America, had no interest in letting British merchants trade there. The company's projected revenues were fiction. The directors knew this. They didn't tell anyone. For a decade, the company limped along. Its stock traded quietly. Then, in 1719, something shifted. The directors announced a new scheme. They would take on even more government debt, about £30 million, an astronomical sum. In return, Parliament would grant them special privileges. The numbers they presented to lawmakers were optimistic, wildly optimistic. Parliament voted yes. In April 1720, the South Sea Company's stock price began to climb, slowly at first, then faster. By May, it had doubled. By June, it had tripled. People who'd bought shares for £100 were now seeing them valued at £300. The wealth was intoxicating. It was also imaginary, but most investors didn't know that yet. June 1720. Coffee houses across London filled with talk of fortunes. Servants were buying shares. Widows were buying shares. A duchess mortgaged her estates to buy shares. The company's directors watched the frenzy and made a decision. They would issue new stock, more shares, more money flowing in. John Blunt and his partners began selling their own holdings quietly, converting paper wealth into actual cash. By August, the stock had peaked. It reached nearly £1,000 per share. The company's market value exceeded £600 million. For context, the entire annual government budget was around £12 million. A trading company with no actual trade had become the most valuable entity in Britain. The directors had extracted enormous sums. They'd gotten out in time. Most investors hadn't. Then in September, something broke. A few large investors tried to sell, others panicked and followed. The stock began falling, slowly at first, then in a cascade. By November, it had dropped to £150. By December, £50. The wealth vanished. Fortunes that had seemed permanent 3 months earlier were gone. The collapse was swift and total. Thousands of people lost everything. A servant lost his savings. A widow lost her home. A clergyman who'd invested church funds watched his institution face ruin. The government itself was implicated. The directors had bribed politicians to support the scheme. Investigations followed. Anger followed. John Blunt, the architect of the scheme, was arrested. So were other directors. Parliamentary inquiries exposed the bribes. They exposed the false projections. They exposed the deliberate deception. Blunt's personal estate was seized, but he wasn't hanged. He wasn't executed. He lived out his life in relative comfort, his wealth already hidden or protected by law. Others suffered worse. Some directors died in prison. Some fled the country. Investors who'd been ruined took their own lives. Families fell into poverty. The economic damage rippled outward. Credit markets froze. Legitimate businesses couldn't raise capital. The crash destabilized the entire financial system. The South Sea Bubble changed Britain forever. It forced the government to regulate financial markets more carefully. It established the principle that companies couldn't simply lie about their assets. It created skepticism about joint stock companies that lasted decades. The lessons seemed clear. Speculation built on fraud ends in collapse. Yet the pattern repeated. In France, just months later, another scheme called the Mississippi Bubble collapsed in identical fashion. Decades later, railway speculation bubbles formed. In the 1920s, stock market excess returned. In 2008, mortgage-backed securities crashed in ways that echoed 1720. The bubble wasn't a unique disaster, it was the template. What made the South Sea scheme work, what allowed it to spread, was something simple. Most people wanted to believe it. The promise of easy wealth was intoxicating. The fear of being left behind when others got rich was paralyzing. The directors exploited both emotions. They didn't need to be brilliant con artists. They just needed to understand human nature. The South Sea Company itself survived. It limped on for decades, eventually returning some value to shareholders. By 1853, it was finally dissolved, but its name lived on in history as shorthand for financial catastrophe. When someone warned of a bubble, they invoked South Sea. When regulators wanted to explain market manipulation, they pointed to South Sea. The bubble became the cautionary tale that never stopped being relevant. Subscribe for more financial crimes that shaped empires, each one exposing how power and greed write history.